Hi, and thank you for watching us here at Tax Talk UK, where we talk about all things tax and consider other important aspects of working for yourself, being self-employed, running a small business. So today we're going to talk about buying assets on finance and how that affects claims and expenditure allowances. And before I do that, if I could ask, please, for you to take a moment to subscribe to our YouTube channel. That way you'll easily be able to refer back to this information if you should need to, as well as finding other information that we have available on a whole host of topics. So back then to what happens if you have a loan or use finance to purchase your assets. So perhaps you bought a van for your business or some plant or machinery, and you've taken out a loan or some finance in order to purchase this. So just to be clear, we're not talking about HP or leasing agreements. We're talking specifically about a scenario where you own that asset, you have bought that asset, and you have simply borrowed some money to enable you to make that purchase. So effectively, the two things are completely separate. So that asset, regardless of whether you paid for it in full or whether you paid for it by finance, you're still able to claim for that in exactly the same way, regardless of whether you've paid for it outright or you have a loan for it. So we talked in a different video about the benefits of being able to claim annual investment allowance or depreciation. So whichever method you decide is best for you, you can do that in full with the asset for the full cost of the asset, regardless of whether you paid for it in full or whether you took a loan out for it. So that is the asset side. So the van, the plant or equipment that you purchased, whatever the asset was, you can still account for it regardless of the fact that you haven't repaid the loan. So the loan then is a separate issue. And the interest that you're paying on the loan is an expense. So you would also be claiming an expense for the interest that you're paying on the loan. Nothing, of course, for the capital payments, because that's simply paying the money that you borrowed. So say, for example, if you borrowed £10,000 loan and you pay £2,000 interest, then as you're making your repayments, the capital elements, so the amount that's just repaying the original 10,000, there's no cost to the business if you think about it, because you had that money initially from the lender and now you're just giving it back. So there's no expense in that. The expense was the actual asset that you bought, which we've dealt with separately. But the interest, so in the example of the £10,000 loan with £2,000 interest, the 2,000 is additional to what you're paying back. So that is an actual cost. So however much interest that you've paid on the loan in the tax year, you will be able to claim as a business expense. And hopefully this helps to explain how the fact that you've had a loan to buy the asset is irrelevant when you're coming to calculating your capital allowances, and whichever method you have decided is best for you, you can still do that in full. So if you're claiming an annual investment allowance and you've had a loan to pay for the asset, you can still claim for it in full, as long as it's, as I say, we're talking about finance or a loan where you physically own the asset. So hopefully that helps to explain. And as always, if you are struggling to get your head around what you're doing and you're not sure whether you're doing it correctly, then it may be time to engage the services of a professional to help you with that. Thank you very much for watching. Goodbye.